Welcome back. This is the fifth video in our stock volatility box onboarding series, and this is where it all comes together. Now, in our last video, we learned that a breach is when the model is giving you clues around having a volatility edge. That's when price action is hitting our clouds. Now, in this video, I'm going to show you how to take that information, the information we have this volatility breach, and turn that into something that's useful and tradable. Now, there's two parts to this. First is when the breach actually happens. The second is what you layer on top to make this a high probability trade. And those combinations are the setups that we're going to talk about in this video. Now let's start with the breach itself. There's two different kinds of breaches that I want to talk about, and then we're going to talk about the different layers. First, the two breaches. The first is the blind breach. The second is the at the edge breach. Now, the blind breach is when price action hits the upper edge of the volatility box models. This is the upper edge of the clouds, and this is what we would call our traditional breach, where price hits the clouds, stays inside of the clouds, and then we see price bouncing. Usually doesn't go outside of the clouds here, and that's where you know this is a traditional classic breach, the ones that you see most often in our YouTube videos, the ones where volatility is being respected, and we have a very nice and clean, easy to read volatility edge. That then takes us to number two, which is when we're starting to see a little bit more volatility. The second setup is the at the edge setup. This is where price goes to the outer edge of the clouds. If you remember, the blind breach was the top of the clouds. The at the edge setup waits for price to hit the outer edge of the clouds before looking at an entry. This means we wait for a deeper pullback. As a result, we're able to move our stops outside of the clouds, and it gives us a little bit more operating room in the trade. Now, the at the edge setup combined with the conservative models is one of my favorite combinations. That's because that's really as conservative as we can get. If you took the at the edge setup with the aggressive models, well, technically we still have the conservative models available to us with the blind breach setup. But the at the edge conservative models really, if price keeps going beyond that, we don't have any other model to allow for volatility. That really means that volatility must be high in that particular market, best to probably sit out. So those are the two different setups that we have with just the pure models. We have the blind breach and we have the at the edge setup. Now, the breach on its own is just a starting point. What separates what I call a tempting breach from a real setup that you want to trade is what you layer on top of this breach. And there's four things that I like to stack, and these are baked inside of our setups. Now, the first thing is the trend. The first question I ask on any breach is this a trade in which we're going with the trend, or are we trading against the trend? For the trend, I like to look at the bigger time frame, the daily time frame, and that's what's baked inside of our scanner and the platform as well. The market pulse is what I use to answer the question, what is the trend? That's because there's no room for any subjectivity. It groups the trend into one of our four different market stages, and with that, we have clean, ready-to-use information. A breach in which you're trading with the trend is one in which, say, you're buying a pullback inside of a strong uptrend. I would call this a high probability play, much higher probability than one in which, say, you're buying a pullback inside of a downtrend. That's what we would call a counter trend trade. And yes, they do work, and you'll find days in which they do work. The one clue that I found, if you are a counter trend trader, the further away the distance from the market pulse line we are, the higher the likelihood that we are to see a sharper reversal and one that I'm looking to play. It's a little bit counterintuitive, but essentially we're saying if we are going to do this counter trend trading, let's make sure we're as far extended to the downside as we can be, that we're already looking for an excuse for a reversion to the mean. So that's the first element, trend. Next, we move on to the component of an edge signal, or something that tells us where we're officially in overbought, oversold territory. Now, with your membership, with your Volatility Box membership, we include the edge signals indicator. This is our custom overbought, oversold indicator, and it's built on a few different components, including the dynamic RSI and a few different proprietary momentum indicators. In plain terms, it's the green or red arrow that confirms the move is exhausting and actually starting to reverse instead of just continuing to run. Now, number 3 and 4 I would call optional, but I found they do help and they add an edge, especially if you're fine with adding a few more indicators to your chart. Number 3 is the Keltner channel wedges. Now, in simple terms, all we're looking for with the wedges is when price is closing outside of the 3.0 Keltner channels. This tells us that we have this natural reason for a reversion to the mean. It's supporting what volatility is already telling us, but now, along with the volatility edge, we have a price edge as well. And finally, number 4 is the momentum cross. This is simply the 3 EMA crossing above the 8 EMA, a very simple indicator, but I found that this is a very easy to read clue that tells you that, hey, momentum is kicking in. Start to look for reasons where the direction is flipping, the final tick on this V-shaped reversal, if you will. So hopefully through this video, the point that's registered is the volatility box is the crux of everything that gives us a clue we have a volatility edge. And then you start to layer on these different components to pick and choose what works for your trading style and where you like to take an entry, where you're comfortable with the entry. If we do a quick recap, based on purely the models, we have 2 different setups, the blind breach and the at the edge setup. The blind breach is our core first setup. Whenever price breaches our volatility box models, that's what we would call at the bare minimum a blind breach. To trade the blind breach, you could combine that with something like the edge signals indicator, where you would look for price to hit our volatility box models. Simply look for an edge signal arrow in the direction confirming the trade, so green arrow for longs, red for shorts, and then use your favorite time frame as your entry. For a little bit deeper pullback, that's where we can use something like the at the edge setup. That's where price is breaching outside of the clouds and we're waiting for a slightly deeper pullback, which allows us more room to give the trade in terms of risk and also aim for a bigger reward. The way to look for these V-shaped reversals, the best combinations, is to look for where we're trading in the direction of the overall longer term trend, look for where we have the edge signal confirmation, combine this with the Keltner channel wedges and the momentum cross indicator for a perfect setup. Most of this is already done for you inside of the scanner. We'll talk about the filters available when we get to the scanner piece, but this is for those of you looking to trade inside of Thinkorswim with the indicator set. Now you have all of the tools, you know how to read the models, you know what each of the indicators serves in terms of its purpose. Now we bring everything together, move on to the scanner, and I'll show you how to pull these setups and have them work for you every single day. See you in the next video.